President Trump's hawkish tariff policy took Wall Street by surprise. Nearly 80% of investors surveyed by Wolfe Research said the tariffs were more severe than they had anticipated. How did investors get yesterday so wrong? Joining us now, Tobin Marcus, Wolfe Research head of U.S. policy and politics. Tobin, why was everyone so taken off guard here?
I think the scale of the tariffs that ended up being announced is a little hard to believe even after it's happened. And so it's not terribly shocking to me that investors had a hard time getting their head around the possible scale of this in advance. Our low end of our range of estimates of what this might look like was higher than some of the other point estimates we saw elsewhere on the street. And this came in higher than the high end of our range. So I think it is definitely an adverse surprise, even to our relatively hawkish expectations. Not, I think, shocking that caught some investors flat-footed.
And about half the folks you surveyed think that there's still negotiation hope here moving forward. What are you telling clients about the likelihood of these tariffs being negotiated downward?
So I am somewhat pessimistic about the prospects for negotiation here. I think when you look at the structure of these tariffs, on the one hand, you have the 10% floor, which limits how much relief most countries are realistically going to be able to hope for. And then the way that these reciprocal tariffs were set, these ostensibly reciprocal tariffs, was based on an imputation of the value of the total trade barriers from any given country based on the scale of our trade deficits with that country. So we're essentially treating bilateral trade deficits as a big problem per se, as a national emergency, in the president's words. And that's going to be a really challenging thing for countries to change overnight. You know, no matter what policy concessions they're offering, whether it's lowering tariffs, lowering non-tariff barriers, it's going to be really hard for any of those policy shifts to make a dent in actual trade deficits. And so insofar as that's been the president's target, I think that's going to be a hard thing to move the needle on.
Tobin, just to translate that a little bit for folks who are not as familiar with some of this trade language, basically the trade deficit is the difference between what I sell to you and what you sell to me, effectively, right? That's the trade gap. And I believe that this was just calculated on goods alone, not on services, which is fascinating because the U.S. is sort of much more dominant in services than it is in goods, right? So what does that also say about whether there's any hope for these things to be reduced?
That's exactly right. We run a big global trade deficit when it comes to goods. We import a lot more goods than we export. We run a significant global trade surplus when it comes to services, with education, financial services, some others being major strong points for the U.S. So on the one hand, I think that exposes U.S. tech companies and other service exporters to retaliation. We'll have to see whether or not other countries are willing to cross that bridge. I think retaliating in that way, rather than just retaliating with tit-for-tat tariffs on U.S. goods exports, probably does increase the risk that the U.S. will counter-retaliate, as Secretary Bessent was warning about yesterday. But the president's goal here is a reindustrialization of the country. The way he has articulated what he's trying to achieve here is that the goal here is to effectuate a long-term restructuring of the U.S. economy in which we're rebuilding our industrial base. So I think that's why we're seeing the focus on goods that we have seen in the structure of this policy.
And we're already getting retaliation announcements from several countries this morning. We're going to throw up a chart right here indicating some of those retaliation efforts that we are seeing from the likes of Germany and France, for example. Here, the EU chief talking about how they are prepared for countermeasures, China and Spain coming out as well this morning. Then Howard Lutnick saying tariffs will go up if a country retaliates. Given that, how bad could these tariffs get if we continue to see the trend we've seen from this morning continue in terms of retaliation?
Yeah, it's really hard to game out exactly how this will go. I do think there is some risk that the tariffs could go up in response to retaliation from other countries, especially if those packages of retaliation include some of these more unorthodox measures like retaliating against U.S. tech companies and other service providers with things like digital services taxes. So I think that is a very sensible concern. Of course, the tariffs imposed yesterday are already immense. So we don't know for sure what appetite the president is going to have to take those further up. But I do think that they will be thinking twice in Brussels and other foreign capitals about exactly how much risk they're willing to take of provoking a further response from the administration. But I think most countries are going to feel like they have to respond somehow. Perhaps not countries like Vietnam, where they're just in a really disadvantageous position here. But peer countries and blocs like the EU, I think, are not going to be willing to take this sitting down with no response at all.
Tobin, beyond tariffs, given that the market has gotten this so wrong, as you said, it was tough to get it right. what else are we getting wrong? What else are market participants getting wrong? And I'm thinking in particular of the tax cuts that a lot of investors seem to be pinning their hopes on to sort of rescue us from this tariff situation.
So, starting on tariffs, I think there is still a big question about durability. And frankly, I think that we would be seeing even bigger declines today if investors were assuming that this stuff is going to stay in place. Again, we are somewhat more pessimistic on that front. So I think we're not necessarily past the point of people having excessive optimism about the tariffs. When it comes to the tax cuts, I do think those are coming, likely in a July timeframe for final enactment. There will be some net fiscal impulse, some stimulus that comes out of those in 2025 and 2026. If these tariffs were to stay in place, that fiscal impulse is much smaller than the face value of the tariffs. I mean, a factor of 4, roughly. But, if we start to see too much economic pain from the tariffs, it's possible the administration is capitulating as we get into, late Q2, early Q3 in the face of economic weakness driven by these tariffs. If we start to see tariff easing that then leads into the tax cuts being passed, I think that would be the optimistic narrative about how things could turn the corner over the summer.
All right, Tobin, got to leave it there. Thanks so much for joining us this morning.
My pleasure.